As you enter into retirement, many of the larger expenses you incur today aren't going to go away. And the problem for a lot of you, and for myself included, is those expenses aren't the same month after month after month. So how do we build that into the budget, into the retirement plan, into everything? And so in this video, I'm going to share the software. There's basically 3 ways that I see as an effective way to build out a retirement plan and incorporate things like a new vehicle, a new roof on your house, a new furnace, whatever it is, these bigger, large expenses. Maybe it's big travel. Maybe you want to go to Europe every 5 years on a big excursion. So there's 3 ways we can budget for that. Let's look at the plan. So jumping into the software here, I just have a couple laid out here. Again, you can do this as a single, as a couple, it's not going to matter. It's the same type of planning. So basically what you need to do is create the starting point. So meet with your financial planner and figure out what's the optimal situation for you, build that out. And as you can see here, this couple has a really nice income, $72,000 after tax for the rest of their life. We just ran this out till age 85. So don't look at all the kind of numbers, CPP and OAS, I just left them at 65. I'm not worried about the tax plan here. That's not what this video is about, although I know a lot of you are going to leave comments. We want to look at how does this couple afford a new vehicle or a different vehicle every 7 years in their retirement. Now, option number 1 is to budget in their monthly budget. And I would say the majority of people do this. So we all realize that we're going to have to change our car. The car that you have at 60 or 65 when you retire probably isn't going to last you to the day you stop driving 85, 90, 80, whenever it is. You're probably going to have to upgrade or change that car. So most of you that we deal with and most people I talk to, they typically build that in your budget. So a lot of people nowadays will have, you log into their bank account, they have their main account, and then they have many multiple sub-accounts. My wife and I have that ourselves. We save for different things in these different sub-accounts. So option 1 would be to save for these extra expenses, whatever they are. We all have different extra expenses, but save for them in a sub-account and budget for it in your monthly budget. So if it's, you need $20,000 for a car every 7 years, you'll figure out how much you need to save monthly and start shoving that away in a side bank account. Make sure it's in a high interest account at the bank, so you're actually earning a little bit of money on that. Right now, not bad money at 5% plus, but that's the first option. So save within your monthly budget. And then when you look at software like this and you look at, okay, what is my income plan? It's $72,000, and in that $72,000 a year, I need to put aside whatever $4,000 or $5,000 depending on your budget for a vehicle, and so that leaves you with $67,000, $68,000 to live off of. Option number 2 would be to actually add those expenses into the ongoing real income, and let's see how that looks. So let's say for this couple, if they needed the full $72,000 to burn every year, there's not really extra money, so we'd have to say, look, we need to scale this down, but let's assume they only needed $60,000 a year. So let's put $60,000 a year all the way down to age 85. I'm not going to ladder it in this scenario, even though they should be doing that, but we're going to leave that out for this video for time purposes. So now they're running at $60,000 a year, which means that if we scale down to the very end, they're going to have a bunch of money. And we'd melt down the RSP and all that. Again, not this video. So you can see here $60,000. Now, let's say they wanted to build in a $20,000 vehicle purchase every 7 years. So at 67, we'd have to add in, if they wanted $25,000, we're going to add in $85,000 that year. And then let's say they need one more car past that. And let's say, again, about 7 more years later, let's go 74. $85,000. This is how you want to run it out. So this would be option 2 is plugging in those big expenses, hit run. And again, this is something that a test you do with your financial planner to see, okay, well, if we live off $60,000 a year and we have 2 years of big spending, we need $85,000 after tax in our pocket, adjusted for inflation. You can see here, no problem. There's lots of money left, hundreds of thousands of dollars left, $800,000 left at the end of the day. So, that tells them, okay, well, could we spend more on the vehicles? Could we upgrade the vehicles more often? And doing these types of tests and scenarios with your financial planner. Now, you don't want to, run the gambit on everything, but get that mental picture. So again, this would be someone you're working with on an ongoing basis. So our clients that we work with on an ongoing basis, this will be, okay, well, how much do we have in the car budget? And we'll kind of run it and see how often, that kind of stuff. So this is the second way to do it. Just have a level income and then just a couple years, just bump up that income. The third way, let's jump into that. So we're back to the $72,000 a year. Now we need to add in these expenses. So let's go into the software here. Again, we use Snap Projections. It's a software a lot of you ask, can we get access to this? It is a software that's only available to financial planners in the industry. But again, we do offer fee-for-service planning. So if you're looking for a very in-depth plan, reach out to our office. We'd love to help you out, or at least have that discussion with you. Parallelwealth.com/planning. So let's go into expenses here and go add expense. So I'm just going to add a car expense. Let's say $25,000 is joint. We want to split that expense over the two people here. Let's just have it increase general inflation. We're going to go from 60 to 85, which is life expectancy for them. And let's just go every 7 years. So we can kind of pick, our duration here. And what you're going to see here is a separate line item. And again, when you're looking for an added expense or an income or whatever it is, everyone kind of processes this different, right? Everyone needs to see it different. Some people need to see it like we're looking at it now. Some people just build it into their budget. Everybody's different. So however you kind of think and kind of like wrap your head around how the process works, make sure you talk to your planner so that they actually build the plan to match the process of how you work. So under the expense column, you see additional car expense. And so there's $12,500. If I went over to the spouse, there's $12,500 there. And then every 7 years, again, increasing with inflation over time. And that goes all the way down to age 85. So 81 is the last one. Now you can see there's a shortfall because we're taking the 72,000. If I go here, you see the 72,000, but there's all these additional car expenses in there. So of course we're running out of money. So then we need to say, if we're going to allocate that amount of money for a vehicle, how much can we actually then draw on an annual basis? Because it's not going to be 72,000. So then we need to recalculate it, and you can see here, we can do sustainability spending for this client based on all the assets they've built up over time. And it knocks them down, actually not too bad, about $4,000, just over $4,000 an annual basis. So they still have almost $68,000 on an annual basis, and they can buy a $25,000 car in today's value every 7 years. So again, you could add in, maybe there's a cruise in here, you could add in every 5, 3, 7, whatever it is years as well. So there's 3 different ways to do it. You need to either build it into your monthly budget. So as you build out your plan and you have that go, slow go, and no go phase, make sure you're building into that ongoing budget those extra expenses, those extra items that are going to come up. The second option is to just kind of bump up that income every single year and show it on your income. So, hey, this year my income's up because I need to, spend some money on a car or a roof or whatever it is. The third way is to actually carve out that expense. Now, again, if you have 15 expenses you want to carve out, doing something like this gets pretty messy. It messes up kind of the plan and spreadsheet. It just doesn't look clean. It actually overcomplicates the process. My encouragement to you is to figure out, okay, what extra expenses am I going to have and how am I going to budget for that heading into retirement? I would say, my opinion back to you and my recommendation back to you would be, I would budget it within your monthly budget. So you're going to need a car every 5, 7, 10 years, whatever it is, and your budget for it. Just work backwards. Take the number, take the years, divide it, and figure out how much you need to save on a monthly budget. And start when you get your paycheck out of your RIF, out of your CPPOS, whatever type of income you have in retirement, carve out a little bit to a side bank account. Keep carving that away. If you're someone that puts that in a bank account and you're like, I might spend that, like it's not a good process for me, then that's not a good process for you. You need to do something a little bit different. So again, everyone's different. Here's 3 ways to do it. Find your way and start saving for those additional expenses in retirement.